All right, so the initial GDP release is out for the second quarter, down 0.9%, making it, of course, back-to-back negative quarters. We did not want to see this. We actually got it. Now, the report, though, to me, it's especially worrisome because of the source of the weakness. Personal consumption, right? Look at that, 1.0. This 1.8 in the first quarter was the lowest since the fourth quarter of 2019. This is a two-year low. Folks, people aren't spending money. That's pretty bad. Particularly on durable goods. That was down 4.4%. Domestic investment also very, very scared. This is a huge, huge red flag. Down 13.5%. It was led by a 14% plunge in residential investment. Now, the news comes on the heels of the FOMC hiking rates yesterday, 75 basis points. And a question and answer period, we saw Jay Powell. He tried his best really to invoke up, his commitment to whipping inflation. The market, though, took its cue from potential markers of inflation more than necessarily the tone of Jay Powell, as the art of interpreting the Federal Reserve Chairman has come a long way, folks, from the days. Remember, you just watched the Greenspan briefcase? Someone who remembers that joins me now, FDIC former chair and Volcker Alliance founding director, Sheila Bair, also author of important financial literacy books for kids, including Shark Scam and Billy the Borrowing Blue-Footed Booby. Sheila, Thank you so much for coming on the show. I got to tell you, let's start with the GDP report. Just your thoughts, the true health and direction of this economy right now.
Yeah, so it's slowing significantly. I think I've been one that thinks that the Fed's methodology, this approach, is very different from what Paul Volcker did, and they're being too aggressive on the short-term interest rate hikes and not focusing as much as they should on long-term rates. So I think we're slowing, and that's good in a way because we want prices to come down. But are we doing this too fast, and are we doing it in the right way? Right. And I think that is reducing the chance of a soft landing, given the current strategy that the Fed is employing.
Yeah, I want to go to that because you actually tweeted after the decision yesterday that you admire their courage, but not necessarily the methods. You said you were impressed by Powell, but that he was actually able to make this unanimous. And I think a lot of people thought that was pretty intriguing. But I do want to start with the first part of this, right? When you talk about their methods, what exactly are they getting wrong right now?
Yeah, so they're not really focusing on money supply. They are kind of making half-hearted efforts to shrink their trillion-dollar, they're not nearly $9 trillion portfolio, but they're really focusing, they're all in on manipulating short-term interest rates, getting short-term rates up. That's inverting the yield curve. Long rates are still low. Inverted yield curves are obviously a strong harbinger of recession. And they're really creating a credit squeeze because on the short side, they're basically paying institutions not to lend below their policy rate. That's how they do this. They pay big banks and other financial institutions a lot of money not to lend, basically. But on the long side, with long-term rates low, why lend long and get that low rate when you're getting paid to keep your money tied up in short-term rates? So I do think that the strategy is one that is accelerating too much of a credit contraction too fast. They should focus on money supply. That is what Paul Volcker did. He did not micromanage interest rates. He focused on constraining the growth of money supply. Let the markets decide what the cost of capital would be. Wouldn't that be refreshing?
That'd be unique these days.
What it should be.
Yeah.
Take some of that excess cash out of the system and let the market figure out what the appropriate interest rate is. That's really the dynamic that led to the defeat of inflation in the early 1980s, and one which I wish they would pursue now, but they're not. They're kind of all in on micromanaging these short-term rates.
Is part of that being all in this one method political? In other words, we talk about Paul Volcker, but since then, no one's really had the kind of will, it appears, in that job to be able to do that. I mean, is it a political will to even be able to go out and do that and be unscathed?
Yeah. Well, that's why I did have to give them a nod. Another 75 basis points was politically courageous. I don't think it was the right move, but certainly it showed independence and determination, at least with this rate hike, to fight inflation. But during his press conference, he really signaled that, they were going to be easing up and that this may be the last of it. And that scared me because the worst thing the Fed could do right now, which is also something that Paul Volcker repudiated, was stop-go policies, right?
Right.
So you raise those rates when the economy's still pretty strong, and then if you go into a recession or if unemployment starts increasing, then you lower the rates again. And there's this constant whipsaw, and you never tease inflation out of the system. And that's why we had inflation, the great inflation, for over 15 years, because that's exactly what the Fed did. And by stopping that, that is how Volcker beat inflation. He had to hold money tight for 2 recessions, but that's what Jay Powell, that's the kind of bravery and strategy we need from Jay Powell.
And of course, that's, you pointed out that in that FT, really everyone told me how great, and I hadn't even seen it until last night, but amazing. I invite everyone to go check it out, your op-ed in the FT. I want to get back to what you said, the nuance of yesterday, because I think there was something really intriguing about that. Powell did harp on the necessity of pain, which I think is interesting because the concept of a, quote, necessary pain is well known and even highly regarded in the spheres of religion or spirituality. I mean, consider virtuous, whether, you want to build your mentality or your physique. But when it comes to the concept of necessary pain for the economy, a lot of folks just don't get it. And to your point, Powell seemed apologetic that his job is going to hurt certain racial demographics, women, overall labor participation. They won't get back to where they were in February 2020. In fact, he's going to hammer them even more. So I guess the street saw that as the first opportunity that he gets a chance. He will turn dovish. Is that what you felt as well?
Yeah, so I think he said, reading between the lines, that recession is becoming increasingly likely, and then kind of winked a nod to the markets and said, once that happens, they'll lower rates again, which is why you have this perverse outcome. We've been living through this for, since the great financial crisis, when we've been driving our economy with monetary policy. Wall Street rallies when Main Street gets into trouble. And that's exactly what, he was signaling a recession will ease up then. Lower interest rates, juice those stock valuations. That's what we've been living with since the great financial crisis. And it sounds like that's what we're going back to again, that's what he was signaling. And that's why you saw the stock market rally. So I don't, I don't want a recession, but I think if you have to pick, hopefully we don't have to pick, it's better to defeat inflation decisively and to risk a recession where at least we have safety net programs where we can protect people who lose their jobs. Inflation hits everybody. It's very difficult to protect people from inflation. That hits everybody. Whether you've got a job or you don't have a job, if you're struggling paycheck to paycheck, your inflation is really hurting you. So we need to, we may have to choose, but I think just longer term, wouldn't it be nice if this represents a paradigm shift where we're going to get away from the Fed and monetary policy driving our economy, because you have these perverse outcomes where stock markets do very well when we get into recession. It's
so skewed. I feel the entire business cycle, organic growth, the things that made America great in the first place. Again, talk about stop and go. The pendulum just swings so widely back and forth. We're talking about rate hikes immediately followed by rate cuts. Sheila, I'm out of time. I really appreciate you coming on and your expertise, and I hope you come back real soon. Thank you very much.
I'd love to. Thank you.
All right, so the market opened slightly higher, and then we really took a pretty good drubbing, and now we're surging back. Now, when we were down, it really wasn't necessarily a surprise because, the fact of the matter is that on the days that the S&P 500 rallies 2% or more on Fed decision day, the next day typically is down more than 1%. But that's changed today, and I want to bring in Slate Stone Wealth Chief Market Strategist Kenny Polcari. Kenny, though, let's go back to yesterday first. The Fed, Jay Powell, you heard my conversation with Sheila Bair. She's absolutely amazing. And Powell did sort of, to me, give the nod that as soon as he gets the green light, he's going to shift back to a dovish position, and the market seems to like that.
That's exactly what the algos responded to, right? They heard that pivot in his conversation, and that's when you saw stocks in the market go crazy, right? The algos, they went into high gear, the sell side canceled, there's a void in prices, and the buyers just came after them and sent the market to where it's at. You saw the NASDAQ up better than almost 4.5% yesterday, which does make sense because it has gotten so beaten up. Any talk of a pivot is going to cause money to go into that sector, which is exactly what we saw.
Yeah, that whole neutral rate thing, I think, caught a lot of people off guard in a pleasant way if you're in the market. What about today, the GDP number? Your thoughts?
Listen, I'm with you. I think it suggests that that tells us that we're in a recession. I don't care what they say that we're not. They're trying to change the narrative, change the definition, but I think we are. The thing that surprised me though was because the Atlanta Fed is usually spot on, right? They were down I think they revised it yesterday to down 1.3%. It came in down 9/10, which was a little bit better than theirs, but certainly well off of what the consensus economists were, right, at plus 3%. So I think that just continues to suggest that we're going into a slower time. We all know that, we can feel it, and that I think it's going to get worse before it gets better.
You know, it's really interesting to me because, listen, I think the market already saw this, Kenny. And, it's so really amazing. We've been doing this for a long time, and we always say, in general, the market knows. The market looks 6 months out. It looks a year out. And we should never second guess the market. So when the market's crashing the way it's crashed in the first half of the year, in my mind, it was seeing recession. And, what I'm concerned about and what people need to understand is we're going to hit a bottom, a stock market bottom, long before recession is over. I want you to take a look at this. This goes back to 1929. This was over 300 days. The market rallied before the recession was called. It's happened almost every single time. And this is the dilemma. Anyone out there waiting for the all clear is going to miss some big moves. So how do you make that adjustment? How do you start to position yourself for the end of recession, even when we're in the midst of it?
You don't make that decision by throwing everything out the window and selling everything and going into cash, especially after we've had the move that we've had over the last 6 months with the market down. Over the long term, you're better off to be invested. You need to, when times like this, okay, you might overweight your portfolio again, and we've had this conversation. Maybe more defensively, maybe more, utility stuff that's boring and beautiful but pays dividends, stuff that's not sexy and all that, but yet it gets you through the difficult time. But
Kenny, when do you start shifting out of some of that defensive stuff into the other high-flying names that, you look around and all of a sudden they're up 30%? I know we don't want to catch every nickel, but some of it you want to catch, right?
Okay, well, of course, but that also goes to how you structure your portfolio in the first place. Look, I haven't gotten rid of my high-growth names. I just haven't added to them over the last 6 months, but I still own them. So if I start to see the market bottom out, it looks like it's going to move higher, I'm already participating, but then it'll give me a chance to also start to add. I haven't completely taken myself out of those names, and nor do I suggest that people over the long term, go in, go out, go in, go out. Makes no sense. You have to stay focused.
I got 30 seconds. So I assume you're sitting on a certain amount of cash. What are you looking for now, though, to start tilting that a little bit more, the portfolio?
Well, so I am starting. Look, you know me. I've been playing it defensive for 6 or 7 months. I am starting to look once again at the mega cap tech names that I already own, but names that I think are going to start to raise their head. So what are they? They're the usual ones. Look, you also have to remember where I am in life and where I am on the risk scale, the risk profile. So therefore, for me, it's Apple, it's Amazon, it's Microsoft, it's IBM in that tech space, right? I'm also starting to stick my nose around some of the industrials. Honeywell, I thought, did a very good job today, right? It's a name that I've been looking at, so it's a name that I might start to dip my toe in.
All right. And by the way, you mentioned Honeywell. Folks, this is the best time. You got to be in this market, taking notes on these earnings. They're telling you everything you need to know. You want to put together a list? Pay attention, particularly this week, the biggest week for earnings, including Honeywell. Kenny, thank you so much, my friend. Always appreciate you.